Welcome. In this video, we'll explore the exciting world of investing using mutual funds, bonds, and stocks. Learn how these options can help you grow your money and achieve your financial goals, all with fun cartoon visuals and easy to understand explanations. Stocks can help your money rocket higher, bonds provide a shield of stability, and mutual funds offer a basket of diversification. We'll see how these investments can turn simple dollars into powerful financial tools, helping you reach your goals. Get ready to see dollars turn into superheroes and markets come to life. Stocks represent ownership in a company. When you buy a stock, you're essentially becoming a part owner. Stocks offer the potential for high returns as the company grows. Visualize it: a stock rocket soaring upwards, showcasing growth potential. Historically, stocks average 7 to 10% annual returns, but be mindful of the market monster volatility. We'll use PE ratios to understand stock values. Bonds are like loans you give to governments or companies. In return, they pay you interest over a set period. They offer lower risk than stocks, typically yielding 4 to 6%. Think of bonds as your bond shield, providing stability and income. Here's an example of a government bond certificate showing the face value, interest rate, and maturity. We'll explore bond durations and credit ratings to help you choose wisely. Bond duration refers to the time until the bond matures, affecting how sensitive it is to interest rate changes. See a steady bond ladder for building wealth gradually. This strategy involves bonds maturing at different times, providing regular income and reinvestment opportunities. Credit ratings from agencies like S&P indicate the issuer's ability to repay. AAA ratings mean very low risk, while lower ratings like junk bonds carry higher risk but potentially higher yields. Companies follow a process to issue bonds, from planning to investor purchase. Government bonds, like this illustrative example, are issued by governments and can be traded, providing liquidity and potential gains. Mutual funds pool money from many investors to buy a diversified portfolio of stocks, bonds, or both. This instant diversification reduces risk. Picture a mutual fund basket juggling multiple items, stocks, bonds, and more. With low minimum investments around $100, mutual funds are accessible to everyone. We'll look at net asset value, which shows the fund's value per share, and expense ratios, which are the annual fees as a percentage of your investment. Let's look at some real-world examples. Tesla's stock skyrocketed from $50 in 2020 to $800 in 2025, exemplifying stock growth of 1,500%. Early investors benefited greatly. During economic uncertainties, U.S. Treasury bonds serve as a reliable safe haven for investors. These government-backed bonds, like this 1967 Treasury bond, provide steady income even during market turbulence. As shown in this yield chart, 10-year Treasury bonds have maintained stable yields around 3.5%, offering predictable returns. Even prominent investors like Warren Buffett have utilized corporate bonds to fund operations, issuing bonds that provide steady coupon payments to lenders. This demonstrates how bonds act as a protective shield, offering stability and income when stock markets become volatile. Vanguard's Total Stock Market Index Fund provides an excellent real-world example of long-term investment growth. Starting with $100,000 in 2010, this fund grew to $500,000 in 2025, achieving a 7% compound annual growth rate. This growth represents consistent compounding over 15 years, turning a six-figure investment into a substantial nest egg through steady market participation. Index funds like Vanguard's offer several key advantages. They provide low-cost access to diversified stock market exposure, eliminating the need for individual stock picking. By tracking the entire stock market rather than trying to beat it, index funds have historically outperformed most actively managed funds while charging much lower fees. This passive approach reduces costs and increases long-term returns. The consistent 7% annual growth demonstrates how compounding works over time, turning regular market returns into significant wealth accumulation. Expert opinions emphasize the importance of balanced investing. Janet Yellen, former Federal Reserve Chair, recommends bonds for stability during market volatility. Looking to the future, digitalization is transforming finance with e-wallets and fintech innovations. Sustainability investments are booming, with ESG funds growing significantly from 2012 to 2018. AI driven investing is revolutionizing portfolios, with corporate investments in AI reaching billions. These trends highlight the evolving landscape of finance. In conclusion, experts advocate for diversified portfolios combining stocks, bonds, and mutual funds. Always consult a financial advisor before making investment decisions to ensure they align with your goals and risk tolerance.